Commit to Wealth Nation, welcome to the Commit to Wealth podcast. I am your host, Juan Vargas. Today on the show, we have Kenny Wolfe. Kenny is the founder of Wolfe Investments, a diversified private equity real estate investment firm. Kenny has been involved in over 2,300 multifamily units and over $100 million worth of commercial real estate throughout several states. Kenny, welcome to the show.
Thank you, Juan. I appreciate it. Thanks for having me.
Thank you for taking the time and making this happen. So let's go ahead and get this show started and tell us a little bit about your background and fill us in there.
So we got started in real estate about a little over 7 years ago. We came from oil and gas. So we were working oil and gas in the Barnett Shale in Fort Worth and then the Haynesville Shale in Shreveport, Louisiana. And then we decided to make a jump into real estate to something that's a little bit less dependent on cycles. And everything is a cycle, but real estate's a lot more a lot easier to swallow than an oil and gas cycle. So that's kind of why we made the jump. We were fortunate. We skipped single family and jumped right into multifamily. We had the funds to do so. So that's where we started out. We invested passively twice to kind of learn the ropes. One was a yield play, so it was something that was fixed up and just spitting out cash flow. The other was a value play. That was we bought it for $13,000 a door. The pizza delivery guy wouldn't go to the on property to deliver pizza. It was the worst on the block. It was rough. And so, so both of those were, and that's called a value play. So, and there the idea is to not get much cash flow the first year or two until you stabilize it, fix it up, and then you either sell it or refinance to get your equity down. So we did those two passively to kind of learn, ask a lot of questions. And then we syndicated our first 76 unit property in Wiley, Texas. That was in 2012. We syndicated that deal. So,
okay. So my understanding is that you got a good start in multifamily. You started off, investing passively, obviously, like you said, and then you kind of, started on your own and doing things on your own and syndicating properties. Before we get into the multifamily, I know that you have done a little bit of a commercial, specifically triple net leases. So, let's talk about that a little bit real quick and tell us why you decided to do that, because your start was in multifamily and what you found interesting in it.
Sure. Yeah. So the triple net leases that we're looking at, and some of them are double net, but those we're focused solely on properties that have guaranteed long-term guaranteed leases from publicly traded high credit tenants. So far we own 4 different Family Dollars. 2 in Texas, 2 in Oklahoma. We've got a third in Oklahoma we're about to close on in 2 weeks here, but we're adding that to our fund. What was attractive about those is that Dollar Tree, who owns Family Dollar, guarantees that lease. So we're getting for cap rates between 7.5 to 9 is the range that we're buying these at. And so when you compare that to the spread on interest rate that we're getting today, it's a much better cash flow option. If you want cash flow, that right now, I think those are the best ways to find it in real estate. The cool thing about them is they're guaranteed by the parent company. So even if they shut down that store, that rent's guaranteed until that long term. So you can work with trying to find a new tenant, things like that, to get it filled back up. But you got that safety stop of the guarantee. And then too, they're double net, triple net. So we don't have any operational risk. So meaning that, the rent, we're not having to chase the rent. There's no evictions, there's no skips. And then that's on the revenue side. On the expense side, we're on these, we're responsible for the roof, the structure of the building, and parking lot, and that's about it. If plumbing goes bad, they've got to fix it, things like that. So very, very steady, very stable kind of deal.
Yeah, and what you mentioned there was the minimal risk because the pretty much the rents are guaranteed, and so that is very attractive. What was the acquisition cost or prices on these?
They range. So far we bought them right around $1 million each. It depends on how much term's left and who's guaranteeing it and all that kind of things. But if it's a brand new one or existing already. So we've kind of bought different ones. So, but all of them are about $1 million.
Okay. And what kind of returns are you getting there for your investors?
So investors on those deals are getting about 8.25 cash on cash, and then another about 8% principal pay downs, and that's before appreciation. So 16.25% total annual return before appreciation on those deals.
Yeah, so that's not bad. And so what is your strategy for these properties?
So plan A is going to be to package them together in the fourth quarter of this year and see if we can sell it to a bigger hedge fund or an institutional buyer as a package, and see if we can make enough money for our investors on that to be just that quick hit. If that does, plan B is going to be a long-term hold. It'll be 7 to 10 years on these deals. You've got to hold them long-term and enjoy the cash flow for this investment to make sense.
And you mentioned that these properties are in Texas and Oklahoma. Obviously there's a lot of benefits in Texas. Why did you look at Oklahoma? What was attractive there?
Well, so really, I mean, we're looking at these deals. We like the Family Dollar, we like Dollar Tree, we like Dollar General. We like all those guys. And what we like about them is that they're safe from Amazon, in our opinion, because they're not the cities that we're buying at are close. They're like 30, 45 minutes away from a major city. But in those towns, there's no Walmart. Amazon can't ship overnight to those towns. So there's a little bit of a protection there by buying a retail center in these smaller towns that are close to larger cities.
Yeah, I like that. I like that you mentioned that, and that's a good value tip is that find a market that is going to be a little bit separate from the Walmarts and those overnight shippings from Amazon. So that was a great point that you brought up there. So what other markets are you going to be looking at as besides Oklahoma and Texas? Is there any other state that you might be looking at for these type of properties?
Yeah, on the commercial, we have a little bit wider net because they are guaranteed by the home office, and there's very little upkeep on our end, while we own them. So we're pretty open to really whatever state that we can find the right cap rate in. Now that kind of hems you in on certain cap rate hurdles, but so we're probably not buying a Starbucks in California anytime soon. But we can, we've looked at deals in Ohio, Michigan. Obviously Texas, Oklahoma, Arkansas, Louisiana, really all of those.
Okay, great. So those are some great points that you brought up there. So let's kind of get back to the multifamily side of things. And what is your strategy when buying and acquiring multifamily properties these days?
So these days, in this part of the cycle, so we started out at a very good time. It was back in 2010, 2012. The issue there then was finding investors and making sure you can get a loan because the deals were there. All the deals were there. We bought our Wiley property back then at an 8 cap, and it was built in 82, which is just unheard of these days, right? So that kind of shows you, and we ended up getting a Fannie Mae loan on it, so that was good. So they were starting to, that pipeline of loans were starting to unfreeze from that huge 2008 crisis, right? So but then investors were a little gun shy about it as well. So so fast forward to today, we've got a lot of folks paying a lot of money for these older buildings now, really low cap rates. I mean, here in DFW, I think they're talking the spread between an A and a C is maybe 3/4 of a point or a point now on the cap rate. So, I mean, it's just, it's pretty out of hand. I mean, if they can't continue this 5% rent growth, I don't see how they're going to make money on those deals. So what we've got to do in this market is find off-market, beat up, ugly properties that are mismanaged, and all 4 is that's even better. But so we're finding, and we bought 4 last year that were off-market, beat up, ugly. This year we're looking at probably another 3 or 4 as well. And also too, you've got to be willing to go outside of the major markets. DFW is to me overbought. Houston's overbought, unless you can just find that off-market deal. But if you're selling a deal off-market, you really don't know what you're doing anyways. Because if any seller should put it on the market these days, because you get 15 offers and the 3 best and final rounds and all that. So so we're willing to go to different markets. So we're looking at El Paso, Shreveport, East Texas, places like that where cap rates haven't really compressed all that much from their historical average. We like that. They have to be in a growth area. So we look at demographics is a big deal. So there's markets that we won't go to that are just, one, I'll pick on Killeen, Texas. I always pick on Killeen, Texas. They're going to write me a letter here pretty soon, but down there it's all military. And so if you have a property down there, I've got a colleague that owns a property down there and just told me he's never wished he bought it down there, because if there's a deployment, he goes from 95% occupied down to 80. And then he's got, so his cash flow is so hit or miss because he's got to, and he did, that deployment, he's got to go in, fix up all those units and then try to release them. So his cash flow is just so up and down. So we look for diverse economies. Example, we own 2 properties in Columbus, Ohio. Columbus is it's the state capital. It's got, the Ohio State University there. It's got a huge medical facility there, a nationwide insurance, Abercrombie and Fitch, Hollister's there. So there's a big, it's very diverse economy. So that's really what we look at for number one. And number two, is it landlord friendly? So we want to stack the chips in our favor. So if there's an eviction, we've got to be able to get them out in a reasonable number of days, and then refill that with the resident who's actually going to pay their rent, so we can pay our mortgage.
Right.
Those are the first kind of two, and then the third, I guess, would be is we want to see low unemployment historically, historical population growth as well. Those are 2 big factors we look at.
Got it. So as far as population, since you just mentioned that, is there a minimum population that you'd like to see that you feel comfortable with, or is that not necessarily something that it's obviously something that you look at, but do you put a lot of factor into that?
We do. So we own 2 properties in Waco, actually 3 properties in Waco. That's probably as small as when it goes, probably 200,000 people. We own a property in Colorado Springs that was about 250, 300,000. So that's probably about the minimum we want to look at. If you get smaller than that, it's probably going to be more of a one economic driver town. If you get smaller than that, typically, you see that. So that's something that we want to watch out for.
Right. And you mentioned earlier when you first started speaking about multifamily, how you first got started, and the debt side, right? So there's not a lot of lenders that are going to be wanting to lend, whenever we have we're at the bottom of the cycle or whatever. So how do you find those lenders that are going to be willing to do that? Do you build those relationships right now since we're towards the top, and have built those, good, strong relationships, and then whenever the market does correct itself, if and when it does, then, you can proceed, or what is your strategy there?
I think 2008 is a once in a 75-year occurrence. I think we're going to have recessions, but I don't think we're going to have one of those for another 75 years, in my opinion. So I don't think it'll be that bad. The next recession, whenever, if that's in 6 months or if that's in 2 years, I don't know. No one knows. I just was at a lunch and everybody's guessing between tomorrow and 2 years.
Yeah, right.
But everybody's been saying that for like 2 years, right? So
yeah, exactly.
So anyways, so this one's got a lot of legs on it. But yes, you're right. You want to build those relationships with the lenders now. We've been a part of, 2,300 units already so far. And so we've worked with a lot of lenders. We do kind of use the same lenders. I like to use the same ones because that does build that relationship. And they're able to give us loans that they wouldn't have to other people if they were first time borrowers with them. So it's important to build those relationships.
Got it. So what are you doing to offset the rising interest rates that we have, today and, tomorrow? What are we doing here?
So on the interest rates, I get that question a lot. We've got, we've got a few properties that we're looking to probably refinance in the next 2 years. So I get that question a lot. What's that going to mean? Over the long term, I don't think it matters. And we're more of a long-term investor in real estate. And so to me, interest rates are going to be what they're going to be. We're still at the near historical lows, even at 5.25, if you look at it. So I'm not too worried about it. Short term, it's going to be some pain. There's going to be some pain for the folks who bought at at these on market, high peak, high leverage prices, if they did that and the interest rates keep going up, I think they're going to be not so much because they probably fixed their rate, but it's more of an issue of can grow that rent, because those interest rates obviously affect credit card payments and car payments and all kinds of stuff like that. So so to me, it doesn't really. To me, it's not. If you're a long-term investor, it doesn't really matter. I hate to say it like that because I know so many people worry about it, but I don't lose much sleep because we buy them. We try to put as much long-term debt on them as we can. And at the end of the day too, one of the coolest things about real estate, rental real estate, is that someone else is paying your loan for you. So if they're paying a 5% or they're paying a 4%, does it really matter to you? Yeah, it's a little bit on the cash flow side, but they're still paying off your loan for you, right? So, I mean, it's, I'm not too worried about it, I guess is what I'm saying.
Yeah. Now you mentioned that you're a long-term buyer, right? So what is your strategy? What is long-term to you?
So we bought just to take an example, we bought that 76 unit deal in Wiley. We still own it. We were able to do a secondary loan on that property, a supplemental loan with Fannie Mae, and we pulled out 100% of our initial equity out of the deal in 30 months. So think about that. We have all of our money out. The money that we put in the property that we invested is out. We have all that back through the supplemental loan proceeds and cash flow. So why would we ever sell that thing? We're getting quarterly checks off a property where we have zero money. Now, it was a 10-year loan, so in probably 2-3 years, we're going to be looking to either refinance or sell. At that time, we'll see what the market is looking like. But if you sell today, you got to figure out where you're going to park your money. That's something else too, right? So as long as we can buy these properties and hold them long term, what with the goal also being to return investors' initial equity as fast as possible. So far, we've done that on 5 of them. I think the average is 32 months that we returned 100% of the initial equity. Part of that's us, part of that's the market. But that's a really cool deal when we can own a property and have none of our money in it.
Now, are these return of capital on refis or are these on exit?
We sold a few properties, but most of those have been, there were 3 properties I took over from some guru groups that I won't name and saved. So those we ended up selling, or 2 of them we've sold. The third I'm working on. We're getting that stabilized, and we'll probably have it fully stabilized within 9 months on those deals. So those 2 we've sold. 2 of my passive deals were sold as well. So there's so we sell them when we have to, or when we get a stupid offer. I mean, we sold a deal in Colorado Springs we held it for 3 years, and then we bought it for $57 a door, and then we sold it for $87 a door 3 years later. So nice. It's $30,000 a door profit in 192 units. I mean, that's just amazing. If someone offers you that, you take it.
Exactly.
So, and also it depends on the property too. I mean, does it have flat roofs? What's going to be the long-term care of it? Does it have wood siding? Does it have a chiller? So we take all that into consideration if we want to hold it long-term. If we do, we've got to make sure to hold back enough money to replace those big ticket items if it has it on there. So anyway, so we've trying to think. I think we only have 1, I think, that has a chiller so far. And we're actually in the process of getting that off there and doing individual HVAC on the property because we like it. We're going to hold it long term.
So, I like that. I I haven't necessarily heard of somebody doing that. So can you talk a little bit more about that? What's the cost, and, how long does it take to be able to implement that to where you can do individual AC units, versus the chiller system?
So really you got to, because it's 133 units, so we can buy in bulk, right? And then we also get the labor in bulk. So it's really not that bad. I mean, it's like maybe $2,000 a unit. Okay. And it's such a better system, especially in Texas. In other markets, chiller's not a bad deal, but here in North Texas, our soil moves. Same thing in Houston, right? And so not so much the chiller, the actual above ground equipment is actually more efficient than individual HVAC. But the problem is that it how it works is it shoots water on underground pipes below the property. Right. So if you have soil movement, it eats away all that efficiency. especially in places that obviously your soil has to move for that to be a factor, but and it is in Dallas and Houston. So so we're trying to get rid of it. We like the property enough to do the $2,000 a unit switch over.
Okay, nice. I like that. So, let's kind of talk about the other markets that you like looking at for multifamily. And I know two of those markets that that you like because we've discussed or we've talked in the past before. One of those markets is Indianapolis. Tell me a little bit more about that market and why you're bullish on that market.
So Indianapolis is very similar to Columbus. Now, I'm not sure if either people in the city would agree with me, but probably for some Indiana Ohio rivalry. But they're very similar. I mean, they're both the state capitals. They both have really large colleges in them. So Indianapolis has IUPUI, so Indiana Purdue University. It's a joint college. And then you've got they have a big Anthem, which is a big healthcare insurance company there. They've got Cummins Diesel is there, so they've got some really big names and a pretty diverse economy. Just like Ohio, they're very landlord friendly. Indiana's number one on the list if you Google it. I'm not sure what they can do more than what we can in Texas, but they're always number one. So I don't know if they can take the doors off or what. On units, but so anyway, so it's very landlord friendly, diverse economy. Indianapolis, strong growth historically, population growth. So it's a good market. Now outside of Indianapolis, maybe not looking at the rest of Indiana, but in Ohio, we're only looking at Columbus and Cincinnati, really.
Okay, and so I know you mentioned earlier that you want it to be landlord friendly. What states do you see that are landlord friendly when it comes to that?
Oh man, let's see if I can name the top 5. So when you Google it, you can name the top 5. But it's Indiana is always number 1. Then I think it's either Texas, Arizona,
Florida or Arkansas, one of those.
I think Florida's up there. I think Colorado too. I mean, so there's and then there's some just right below there. So we're we've got properties in Ohio. It's very landlord friendly. It might take an extra day or two beyond what Texas does. So it's
not that big of a deal. Yeah.
Yeah. Okay. So, but yeah, I think those are the top 5. So we're looking in Texas, Oklahoma, Ohio, because we're already there to add to units, and then Indianapolis would be great. New markets in Texas we're looking for is El Paso. We like El Paso. I'd love to get back down into Houston. We owned one briefly down there for 2 years, and then flipped that one. But the prices down there are so crazy in Houston, so I'm not sure if we can find something yet. But we'll be back there soon.
Yeah. So you just touched on El Paso, and I wanted to ask you about that. What important key aspects and that you see in El Paso to make you want to jump into that market or even look into that market?
Yeah. So El Paso, I've been looking there for 2 to 3 years. It's been kind of tough to break in. There's not a lot of third-party management options. So we always use a third party, or we did in the past. We've recently acquired a large stake in Allied Property Management. So we now own a property management company. So we can actually put them out in El Paso, break into those markets where it's kind of shielded from outside investors a little bit. But we liked El Paso because it's the 19th in population. So it's 1 million people, but it ranks 10th on trade. So per capita, it's a pretty wealthy city. I mean, it's like over 50 grand median income there. So it's a pretty wealthy city. The past 4 years, it's ranked number 1 or 2 of the safest cities in the U.S.
Wow.
Yeah.
See, and that's a stat that I find surprising right now because of how close it is it's on the border of Mexico, right? So,
yeah.
You've heard, a lot of bad things going on, right there at the border, but
sure.
That's a surprising stat to me right now. That is
and so we make sure to, talk about that because we do like it. It's got, you got a big army base there. It's the biggest, I think it's the largest, import export between U.S. and Mexico for goods, so a lot of that alone is a huge diversification right there because that's not going to shut off. We both need each other very badly. So it's a safe city. You've got an army aspect, good growth, 1 million people. UTEP is out there. It's 20,000 kids. And then they've got a community college that's about 20,000 kids as well. So
Got it.
you got a 40,000 student base there too. So diverse economy. If you ever get a visit, it's pretty cool. It's 4,000 feet in elevation, so it's very high desert kind of atmosphere. So it's pretty cool.
Nice. Yeah.
So, but we like it a lot. Very diverse, and there's a lot of it. It's kind of like going into Columbus, Ohio for the first time. When we went up there, the locals really weren't. They're putting some money back in the property, but they weren't doing a premium or an upgrade unit package and charging more for it. We're seeing the same thing here in El Paso. I mean, this deal we're buying, it's got the owner put plank faux wood in probably 3/4 of the units, but he didn't charge more for it. I mean, that's at least $50 right there. There's, we typically do, we dress up the kitchens with some backsplash. So we'll do something above and beyond what he did, but he did a lot of these improvements and didn't charge for them. So in Columbus, Ohio, we were able to charge like $150 more for about a $3,500 unit rehab of interior improvement. And so
Wow.
when you're seeing that, you want to do that all day long.
Right.
So it's great when you go to some of these markets that are smaller that haven't been touched yet, and introduce that option.
Got it. And so let's talk about this specific property that you acquired there, the El Paso property. What's the unit size, acquisition price, and tell us a little bit more about that property.
Sure. So it's 188 units. And we look at a metric. One of our kind of metrics we look at. We get excited when we see we look at the median income in that immediate area within like 2 or 3 blocks. And then we try to get that median income. If we can buy a property on a per door basis, about 1-to-1 ratio to the median income, usually that means it's a home run. But that also means usually there's some kind of deferred maintenance, or because somehow they're not charging enough rent. Because if you're 1-to-1, that's a pretty good ratio. There's room for rent growth, somehow, some way.
So wait, let me go back to that. You said if you find a property that is the cost per door is the same as pretty much one salary. Is that safe to say? So if you're buying a property that's $50,000 per door per unit, then and if the 2 blocks, 2 streets, or whatever around there are making $50,000 per year, then that's a home run. Is that simplest terms?
Yeah, usually that means it is, for us anyway. So because if you think about it, when you go get approved for a house, they kind of approve for 3-to-1. We're in the apartment world, so we're not in the higher end folks that are buying units or buying their own house. So most of the time, so when we can find properties like that 1-to-1, they can definitely afford more rent on the deal. Got it.
Those are some great points. So I appreciate that you were able to share that and share that with myself and the audience. So that's great. Let's talk about your hard money loan side of the business. So I know that you offer that service. Let's talk about what kind of properties you like working with, and who your typical customer is for that.
Sure. Yeah. So we got a hard money lending arm. We've lent everything from single family, a 36 unit multifamily deal down in Baton Rouge, and then we actually have one guy use us as a bridge to buy an office building for himself. So it's really a bridge product. I mean, you don't want to. It's a higher interest rate, but what we bring to the table though is we can close quick. We only we're always the first lien holder on these loans, and so we really just look at the property and base the valuation off that. We don't run credit, we don't do anything like that. So it's people that want to move quick. Most of the time, it's flippers that want to instead of them just being able to do 1 or 2 houses at a time, they want to add a third to kind of do more at once. So that's typically what we see on those hard money loans.
And what is your acquisition, prices? What is your range there? Like, if I found a 50 unit, multifamily property, and it's 50% occupied, and maybe hey, I can give Kenny a call and see what kind of terms he can give me. What will be the terms, typical terms on that size of property?
So on the 50 unit, we'd probably do a $3,000 application fee, 2 points at close, and then a 12% annual interest rate, but no prepayment penalty. So you can pay us off in 3 months, 8 months, whatever it is. You want to exit quickly because it's a higher interest rate, but But that's what the numbers are.
Okay. Okay. So yeah, this is, it's a great way to get into a property that you otherwise couldn't get into, but you got to make sure that you're pretty quick because there are higher interest rates. So that's a great product to have around and have in your back pocket. So awesome. So Kenny, it's time for our nuggets of wealth. These are basically questions that I ask every guest every week, and hopefully they're able to help the audience in one way or another. Okay.
Sure.
So what key tip or advice would you give to others who want to take their business to the next level?
I mean, it's going to sound cliche, but think bigger. When we were getting started in real estate, we, making the decision between single family and multifamily, we made that jump without going to single family. So think bigger. You can always find, if you're missing something, if you're missing part of the package, whether it's the net worth side, even the equity side, something else you're missing, you can always find someone to partner up with to start bigger, faster.
Yeah. So that's the same kind of advice that you would give yourself maybe whenever you first started to think bigger, right?
Yeah.
Maybe go faster instead of, taking it slower. And I would say, if I had to give my own personal, opinion and advice, I would say you skip the single family, you skip it altogether and then just jump into the bigger properties. Why not? It's more of a mindset shift, so great.
It's much easier to buy a 60 unit property than a duplex.
It really is. It really is. And that's one of the things that I found out, quickly was that, it really is. It's so much easier to get into these larger properties versus, a smaller property where they're looking to take your kids and your kids' kids, later on, for recourse. So yeah. Right. What is a good tool, source, or platform that you use frequently that can also help others?
We network a lot. So, we go to a lot of events. We host our own meetup event here in DFW once a month, have a guest speaker. But it's you really got to network, especially these days. And it's got to be in person if you can. That makes it so much better. So we network a lot. We go to a lot of meetups. We speak at a lot of events. And that's how you grow your business in real estate is because you got to meet the brokers, you got to meet the lenders, you got to go and build your team. And the only way you do that is by showing up to these networking events and passing out business cards.
There you go. I like it. What book are you currently reading?
Currently I'm reading, usually I'm reading a book, but it's been so busy. I'm actually not reading a book at the moment. We just put out our own. So I've got a book out on Amazon called Investing in the Dream. Okay. And then, so I've got that on there now. We hit bestseller status on Kindle, so that's kind of cool.
Nice.
On there. And we sold one I think in Australia. So we can now say we're international.
There you go. Well, takes one, right?
That's right. So anyway, so we've got that out. We've been so busy at the office, but usually what I'm reading are, business biographies or autobiographies, really to learn from these guys on how they did it and how I can, think bigger from where I am today.
Got it. Okay. What is the best business advice you ever received?
Best business advice. Got to think about that one. Really, it's been a lot. I've learned a lot from a lot of people, but it's been mostly, I guess the big one would be go big or go home. We learned that lesson. My wife and I, right out of college, bought a tanning salon, and we wanted to be entrepreneurs, right? And so. But it wasn't big enough to where we could work on the business and not in the business. And so my wife had to be the manager, and that we both didn't like that. And so that was a lesson we learned. And that was probably the biggest one is that, we wanted to start a business where we can work on it and not in it. It's a big difference. It's only one letter difference, but it's a big difference.
Yes, it is.
Because you can't scale up if you're in doing the day-to-day operations.
100% agreed. 100%.
Yeah. You gotta start big.
Exactly. I love that. Where do you see your business and company in the next 10 years?
So, we've just made that big move to be a fully integrated private equity real estate firm. So that's a whole long word, but we'll do that. We've got three different offerings we offer now. We've got a development project that just myself and one other person are working on to figure that out. So we can offer those four offerings to our to our investors, we're going to stick with real estate. We're going to focus on that, but we've got 4 different levers to pull at no matter what time of the cycle we're at. So, between the hard money lending, the commercial properties, multifamily, and then the 4th is we're doing some development on 6 townhomes here in DFW, trying to figure out the development piece. So we'll be offering that. I see us growing a lot bigger, especially with this big bolt-on of bringing Allied Property Management as part of Wolfe Investments in our deal. So it'll streamline a lot of stuff that we already own, but also give us access to new markets like ones that like El Paso or Colorado Springs, where there may be only one or two options for third-party management.
Okay. I love that. So you pretty much, have different, legs to your company that all work together. And so I really like that. Really like your company plan and the way it's structured. So great job there. At the end of your life, how do you want to be remembered?
I like to teach people. I'm not a mentor. I'm not in that business, but I like to help people when I can. We've got interns here every summer that they learn a lot. They're thrown a lot at, and I think that's a big deal. And then someone who also provides another source of income from somebody's paycheck or pension or retirement. So they're more diversified on their income streams.
Got it. Great answer. So Kenny, where can Commit to Wealth Nation go to contact you and find out more about Wolfe Investments?
Our website is www.wolfe-investments.com. That's the best way to get a hold of us.
Okay, great. So Kenny, thank you so much for sharing your advice and your tips, and thank you so much for your time, and I wish you continued success.
All right. Thanks, Juan. Appreciate it. Thank you very much.
Yeah, likewise.